Okay, great. Okay, welcome everyone. Welcome to Understanding Credit and How It Affects Your Interest Rate. We have with us tonight Julia Fontanelli. And before we begin, Julia, why don't you just tell everybody where you work, how long you've been doing it before we dive into this great topic?
So I work for First Priority Mortgage. It is a mortgage bank owned by Howard Hanna Realty, and I've been with them for almost a year now. And I'm just kind of starting out my journey.
Yay! I love journeys. You never know
Yeah.
where it's going to take you. Okay, well, welcome. Now, this topic, understanding credit and how it affects your interest rates, this one was a very important one to me, an interesting one, especially me being a realtor. I feel like conversations are being had before people get to me. So sometimes people may think in their mind, like, oh, no problem. I'll be able to get like a $250,000
Yeah, because they
home.
look on Zillow.
I honestly think that is, I don't want to say anything negative, but it's just like, I think it gives people false expectations. Let's just say that.
Yes.
But I feel like people are going to the lender, and then there are other components that come into the mix that I don't feel a lot of times buyers are really understanding. And so credit plays an important part in the whole entire process, but most importantly, the interest rate is what you're going to be paying, and that is established based on your credit. So I guess my first question is, how does the credit score affect the initial interest rate on the mortgage loan?
So basically, in a nutshell, the better your credit, the
Mhm.
better your interest rate. So the better your credit is, the better interest rate you can get from the company that's offering whatever their lowest interest rate is. When they advertise interest rates as low as,
Right.
if you have a really awesome credit score, then you could get that interest rate. But sometimes people, if you don't have a a credit score that's high, if you have just like a 620, then
Right.
you're not going to be able to get the prime interest rate.
Mhm. So, say for instance, someone was going to apply for an FHA.
Mhm.
And currently, and this is just hypothetical, the interest rate for an FHA right now is like 6.5.
Mhm.
Now, 6.5, when they're advertising that with the lender, is the 6.5 for great credit, or is the 6.5? So the 6.5 is for great credit.
Yeah,
So that's not for someone who has the 620.
right.
So if someone so if someone has a 620, what potentially kind of interest rate is someone actually looking at?
Um, I'm actually not sure how many points higher they,
Mm,
they scale it off of.
mhm.
I just kind of I run the person's credit,
Right.
and then I put in some other information, and then based off of that, I get a bunch of rates. And like they could get that interest rate, but they'd have to pay points.
Oh, gotcha. So more out of pocket cost.
Right. And so the ones that I always go to are the interest rate where they don't have to pay points, but they're higher.
Right. Mm,
Yeah.
yeah. And so if someone has a high um interest rate, are they can they wait, like say, behind the scenes they're doing whatever it is that they need to do to try to clean up their credit and stuff like that, and maybe they just have a kind of like debt to income ratio is a little bit high but it's still acceptable. So
Mhm.
if they get that under control and pay off some bills and stuff, is is that because I thought people are really refinancing based on the fact of just the rate, but are there people who
Yep.
are actually refinancing because the rate was affected by their credit score?
That's a great question. I haven't come across anybody who's refinanced off of their credit score yet, but
Mm-hmm.
I think that's a good point because a lot of people don't even realize that. I think people, when they have a lower credit score and they actually get a mortgage, they're happy that they, even got the mortgage. And
Right.
then I think they kind of just stick with that
Mm,
interest rate. I hope that people know that you can look to refinance
Right.
once your credit score has gone up, because you will get a better interest rate later on.
Yeah, I absolutely, and that's just it. I feel like the conversations aren't being had because I agree with you. I think people are so happy to
Mhm.
hear that, yes, we're able to give you a mortgage, that they're not really calculating the fact that the interest rate that the lender is offering them could potentially add
Right,
on, by the time you get the PMI on there, and then you're just factoring in taxes, and just it really can be a hefty amount of money. And people, that's how people kind of like get, buried and, they're house poor. So you have the
right,
house, but you can't afford to live, which is not
right.
really, not
And I
really a
think
great thing.
because credit is like such a just wild thing, and people don't fully understand it, that maybe they don't recognize, like, okay, let me work on my credit and pay my mortgage for the next year or two, and when I have a better interest, or when I have a better credit score in a couple of years or so, or
Right.
however long it takes, I will look to refinance. I think people forget about that because
Hmm.
credit is so crazy and people don't fully understand it.
Yeah, yeah, that's too bad. Now, is credit score the only thing that affects the interest rate, or are there other factors?
Like you said, debt to income is like a big factor too.
Hmm.
I had someone who was perfect for this house, and it was actually a USDA loan, and I was really excited to get him this home. Um, but unfortunately, he made a decent amount of money. It wasn't like he wasn't making any money at all. He was making a decent amount of money, but he had a really high truck payment, and
Mm,
his debt to income, he didn't have anything in collections. It was just that his truck payment and a couple credit cards, his debt
right.
to income was too high, and he couldn't get approved for the USDA loan, unfortunately.
That's too bad.
Yeah.
Yeah, I don't know anyone who's had the USDA loan, but I've been looking into it because that's rural areas, right?
Yep. Yep.
Okay. And
Listen, and I think people should always check that first, because if they are under the income limit and the property they or area that they're looking in is in the
mhm,
USDA limits, then
right.
I would definitely look into that, because
Yeah.
you don't have a down payment. So
I didn't know that. So for
yeah.
USDA, you do not have a down payment. Wow, that's great. Just closing costs.
Yep.
Wow, that's amazing. Yeah, I learned something new today. That's my thing. Because I did not know that.
Yep.
Okay, let me just see here. I'm looking at my cheat sheet. Let's see here. So we did do that. Okay. Now, I have a question. How many times is the lender actually pulling the credit during the duration of, like, initially when you go, they find the home, they're going through
Mhm.
the whole process. Are you pulling it another time or just that initial time?
It really depends, because if the process, we pull it once, and
Mhm.
then that's good for 120 days. So if the process takes longer than 120 days, right before we submit everything, we'll just pull it one more time. But can I tell you, I've actually had someone's credit go up
Oh, that's
during
good.
that time. Yes, and it helped. It brought his interest rate down.
Oh, that's
Yeah.
awesome. I love
So
that.
yeah, me too. I was happy for him. So because he
And
was
that was
just at
like
the
a
border of
shock.
it. He had a 620, and then his son had to come onto the loan because his son had
Mm,
that credit. And but by the time we pulled his credit again, the 120 days had expired. He
right.
actually had higher credit, which was great. So
Oh, that's amazing.
mhm.
So it will probably be, and also, are you looking also too to see if anything has happened, like like they've made hefty purchases or anything
Yeah,
negative?
definitely, because I don't know. A lot of people do this actually. They're looking to buy a house, and then they're like, you know what, I want a new car too. Well, and they forget that that affects their
Yeah.
debt to income. And then, a lot of the times they can't be qualified for the loan if they're just on that borderline there.
Yeah, that's crazy because you
You have to
can't, they
recalculate everything.
do not make any purchases if you are buying a home. You can wait till after, but just
Right.
not during. Because
Yes, please.
unfortunately,
No.
you'll be able to, you have to not go forward then, because that changes things
Right.
drastically, especially, yeah. That's too bad.
Sometimes people, it's fine. Like I just have to recalculate everything. But a lot of the times, if people are right on that borderline of, being approved or not approved, it will affect
Mhm.
it. It won't be approved.
Now, can you explain the points? Because I've heard them say that regarding the interest rate. So if you have a low credit score and you may qualify for a certain interest rate, but you may have to buy points. And so what are the points? Explain that for people who don't know what that is.
So buying points, a point is 1% of the loan.
Mm-hmm.
Okay, so you pay 1% of the loan, and it brings the interest rate down 0.25%, which
Okay.
is, so you'd have to buy 4 points to bring it down an entire percent, and that
Oh,
can get
wow.
pricey,
Yeah.
and that's on top of your closing costs and your down payment.
Oh, wow. And is that incorporated into the mortgage?
No, I believe you have to pay points.
Really?
Yeah,
Oh,
up front.
no.
Yeah,
Oh, that's a hefty amount. I
yeah.
kind of feel like if you had the low credit score, I would say at that point, if that were me, I would just forget about the points and just ride it until I could possibly refinance because that's a lot of money.
Yeah, I agree. And I mean, on top of the closing costs and the down payment these days, I mean,
Right.
it's thousands of dollars. Actually, I mean, think about it. So if you're buying a house for $100,000, which that's pretty much unheard of these days,
Right.
and to buy 4 points, that's an extra $4,000.
My gosh. Just for that's just a lot. Yeah, that's
Right.
wow. So now what happens with when you're locking in your rate? Because that's another thing. Someone told me that one time things were taking too long. So they locked in the rate, but is it only for a certain period of time? And if everything's not tied up before that deadline, then do you lose the rate and you have to pay it again?
No, I think that when you lock in the rate, it's
Mm-hmm.
just locked. It's your rate.
Oh, okay.
I,
So there's no
yeah.
expiration date for the locked in rate if the
Right.
process.
It's just like the rate, if we're just looking today and the rate's at a 6.5,
Mhm.
and then it's like, okay, next week you're like, okay, I want to go through, and then next week it's at a 7. It's
Mhm.
nothing you can do.
So let me, is everyone, every lender, not every lender, but is every mortgage that's available, are you able to lock in the rate?
Yeah, I would, that's like a big part of it. You know what I mean? I feel like if
Yeah.
people are very serious, you want to, and you're okay with that rate,
Mhm.
then lock it in immediately.
And
Um, I
what
just,
if the next week it goes down?
I mean, the rates change every day,
I know that's what's so crazy. It's like
you
Russian
know?
roulette. Are you penalized if I'm locking it in, say today at 6.5,
Yeah.
and then 2 weeks down the road, now it's at 6? Can I come to you and say, say, Julia, it's
You
at
know
6?
what? I honestly, I have not come across that yet.
Because I'm like, I would be so, it's almost like when you go to a store and you buy something at like say Macy's and then you see it at
I
Bosco's.
know. And the sale price, and you're like, why?
Yes,
But I can tell you that I haven't had rates be significantly
right, where
higher
it would
than
make a
lower.
difference. Okay.
Right.
Because the rate is just, it's a huge factor. And I think, people really need to understand. And basically all I'm hearing is credit, you have to be diligent and you have to just make sure that your debt to income ratio is not too high. You have to make sure you're paying your bills on time.
Mhm.
No collections, no late payments. Try to stay within the 30% utilization of your credit cards. Like it really is a part-time job when
Right.
you want to go and get the house. Yeah.
Right.
So let me just see if I hit all of my questions that I had. Let's see here. I think I did. Let's see. Oh, one last question. Now, does the lender, because I know credit cards do this,
Mhm.
they pull your credit like after you've been approved and you've had the card a little bit. Sometimes they'll pull the credit and they will either give you a credit increase
Oh,
or they actually change the interest rate on your credit card if they feel like you're using it too much and it's about to be completely maxed out, because now they're just going to like, really hit you really hard. Do
mhm.
lenders pull your credit after you've signed everything and it's just all over?
No.
Oh,
I
that's
mean,
good too.
it's like, it is what it is when you sign, you know what I mean? That
It
would
is
be,
what it is.
imagine all that. I mean, to be honest, that would be like a lot of work for lenders to keep up with.
Right.
And it would just be constant, like hiring and lowering.
Hmm.
That's why it just is what it is. When you,
Oh, okay.
so that's,
Yeah.
I think lenders kind of like, I mean, because they're making money, right?
Right.
So I don't know if they not hope that you don't realize like, oh, let me keep on my credit and check, and once I get a higher credit score, I will refinance. You know what I mean? I think
Right.
that they just kind of leave it be.
So now I just want to touch on before, like when a lender is posting the
Mhm.
interest rates they have again are for good credit. But is there a range of how high that the interest rate could get for someone that has because I'm just trying to get like a range if there is one, or is it just really based on a number of factors? Like you said, you put in some figures and
Yeah.
they're okay. I was just
Yeah,
curious.
I just like, you mean a range for like the
Like
interest
if
rate and
I
how
have
it
eight,
would go?
yeah, if I have an
I think
800.
that I think that kind of like dips into when people have like a really low credit score and they have
Mhm.
those lending companies that will lend to people with bad credit
Right.
and then they charge them more for that. I think that's where that dips into that. I know we go 620 or higher. It has to be 620 or higher.
Now, how do you deal with a married couple? So if a married couple comes in and you have the husband who has a credit score of the 620,
Mhm,
and then the wife has a credit score of 800,
mhm,
and you need both incomes in
mhm.
order to obtain the mortgage, how is the rate factored that, because it's such on the ends of the spectrum? How do you determine the interest rate for that?
So, a lot of the times, if one spouse has good credit and one spouse has less than a 620, then we can't put that spouse on. If they have a 620 or higher, we would have to use that credit.
Mm,
Use the lower, which kind of sucks
that
because,
does. So even
yeah,
though the one spouse has a higher credit score, you have
yeah,
to the lower one?
yeah,
Oh, wow. I would kind of feel like it wouldn't even be worth it to go forward until the lower credit, because that's such a big range.
I
Someone
know.
has, yeah, a 800 and the other has a 620, and you have to go with the 620. Wow.
Right. Yeah.
Yeah. It almost makes more sense for the
They're
person.
both and they will both be on the loan and we will see
Right.
both of the credit. It's just using both the incomes and everything. If you want to use
Yeah.
the income, then, you know, because
Yeah.
the spouse with the 800 credit score, they could just say, just put it in mine and not their spouse doesn't have to be on it. If their
Oh.
Yeah, their spouse doesn't have to be on it. If, say the one spouse had like a 600 credit score and was only making an extra 20 grand a year and they were like, you know what, it's not worth it. Just do mine and with my income, then you don't have to have the other spouse on.
Oh, okay. Now, do you have different types of mortgages for people who have a low credit score versus who have a higher one? Because I know like sometimes you'll have like those credit cards where they're like, this is perfect for someone who's trying to establish credit. And I know credit cards isn't the same thing as a mortgage, but I was just curious, like, is there like when people work with a broker, and they have because I've heard this before, like brokers have so many different people that they
Mhm.
can go to, and shop around for someone who has poor credit
Right.
as opposed to. So I was just curious, like, does first priority mortgage have something like that for people with low credit or high, or it's just anyone who
The
just
only thing that we would have for that, I would say, is like the Sunny May program, and that's for people with like new credit, not
okay.
bad credit. So if you have, say you just graduated college and you've had a car payment and you're trying to get a mortgage now, you have newer credit, but not bad credit, then the
Right.
Sunny Bay program, but it has to be a 620 or higher. And then, so if you have a 620 or higher, and then we kind of work with it to see, you know, what we can do and what interest rate you'll get.
Hmm.
That's why we have such a range of, you know, interest rates for people. When you have a 620, it's lower. I mean, not
Yeah.
when you have a 620 credit score, then you have a higher interest rate, but yeah.
Yeah. Now, if some say, okay, so now let's just say a year has gone by
Mhm.
and the person qualified for a higher interest rate based on their low credit. But now the 620 turned into, let's just say miraculously, now it's at 740.
Mhm.
Is that a significant jump in order for someone to try to refinance? Or like, what is the amount that they should really want, that they should see before they even contemplate coming back to refinance to try to get a lower rate?
If they have a 620, I would say anything like you said, 640 would be
Mm-hmm.
good to come back and try to get a new
Okay.
rate.
A
Yeah.
640? Oh, wow.
Yeah, I think so.
I
Yeah,
was,
like I would say like 640 to or I'm sorry, 740.
oh, because I was going to say, I was like 20.
Yeah. Oh, I'm sorry. My
That's
mistake.
okay. I was like, wow, just 20 points?
Yeah. No, I definitely like if they have a 620, then I would say anything, you know, 740, 760,
Mm-hmm.
that'd be great to look at to try to see what the rates would be for them. And if it's substantial, then they can refinance.
And so what when you're refinancing, what are you doing? Just taking whatever the first mortgage was and paying that off in its entirety, or just kind of like redoing things, recalculating and saying this is actually what you owe now as opposed to what we initially said?
Yeah, so a refinance is just basically you'd be getting the lower rate
Hmm.
and it it just like consolidates into you'd have the lower rate with what
Hmm.
you owe on the house still.
Oh, okay.
Yeah.
So I mean, at least it gives people hope. I mean, it's not forever. So if
Right.
I guess the thing is, if someone comes and they have a 620 and unfortunately they're going to have to obtain the higher rate at that point in time, I guess you just need to just really work as hard as you possibly can over the next year.
Right.
And yeah. Do you have to go through that whole process, like what you went through, the first process, giving you all the documents and pay
Yeah,
stubs?
because they would want just you would have to do like newer tax forms and stuff like that, depending, like especially the amount of time that goes by. I mean, sometimes even within one process, like the bank statements and the pay stubs, we renew those. So
Mhm.
if it's a long period of time, then definitely, yeah.
Okay.
We want
I probably
anything.
think it won't be as long because you don't have to get an appraisal or anything like
And
that.
you know what I mean? It's always
Okay.
tough the first time around because you don't know what to expect and you don't
Right.
know how it goes. So it feels like a lot to hand in all these documents. And it's like,
Yeah.
it feels like we ask for everything under the sun. But then the second time around, it'll be easier because you know what to expect. So you'll have everything on hand,
That's
hopefully.
true. I agree with you 100%. I really just feel like this is just a topic that just needs to just continuously being had, and so that people really do understand credit literally is tied to
Yep.
everything in your life. Like, it's just amazing to me, and I don't really think that enough attention is given to it, because it really just has so much effect on everything that you do that is tied to anything financial.
Oh, I know. Yep.
Down to your auto insurance. Like,
Oh, I
it's
know.
crazy because I didn't even know they did that. I
I
think I
know.
found that out in my 20s, and I was like, wait, you're checking my credit?
You're like, I can't get away from this, you know?
You really
It's
can't.
everywhere.
It follows you forever. But and I do thank you for joining us tonight. Let me just see if anyone has any questions. I'm just going to check the chat. I don't see any questions, but I do appreciate you joining this evening.
Of
And
course.
thank you so much.
Thank you for
I
having
enjoyed
me.
like our weekly conversations that we have, because like I said, I think it's very important that people really do understand the process, because I kind of
Yeah.
feel like it's almost like a wedding. It's, there's that builds up in the excitement, and there's focus on certain types of things, but then there's no focus on just like now that the wedding's over, now what, you know? And I think like when you're having it's like the same analogy having a baby, you have the
Yeah,
shower and you're like, what am I doing? You know, and you have this house. But I think it's important that people understand that interest rates, the lower your interest rate, the lower your mortgage payment, and you're just in a better situation.
right.
And maybe sometimes it's better to just wait, work on your
Yeah.
credit,
Yep.
try to get the best, especially now. I mean, I did see an article the other day where they're saying that interest rates are on the horizon to be a little bit lower. So, I mean, that's a little bit, that's very optimistic. I'm happy
I
about
did price the loan the other day for under 7, so that's
it.
exciting.
Yay. Because that, I mean, I remember when they were like three something.
Oh
I mean,
my
that
God.
seems,
The good
my
old days.
my friend, he told me his is 2.5. Like,
Wow. I hope
he got
he's
it.
gonna stay there
He
then.
said he will never touch it. He has a 2.5 interest rate on his, and that's literally where we are right now. That seems like, oh my God. But yeah. But like I said, thank you so much for joining us tonight. And I've learned something new and I appreciate it. And until we meet again, have a great
Yeah,
evening, everyone.
you too.
Bye bye.